We think recession next year in the US is very likely. We've got a Fed that is about to over-tighten policy if it hasn't already. Credit conditions in the banking system are tightening up. The yield curve's inverted. The corporate sector is looking quite overstretched on a few measures. And I also think we're set for a pretty major retrenching in housing and manufacturing sectors in the US. So look, I think the US and global economy is under pressure, and the bear market in equities will endure as a result.
Interest rates going up, the banks being the winners of that still looks intact. That should be a positive factor for the banking sector, but you still see the banking sectors as the worst off in this gloomy scenario that you just painted.
There's a really key correlation here with respect to that question is Eurozone banks with bond yields and with in particular the 10-year, the German 10-year Bund yield. Now the correlation is pretty good most of the time, and what you get ahead of and into recessions is Bund yields falling very sharply, and banks usually, financials generally I would say, but banks especially, underperforming the rest of the market as you price in recession. So I don't think we're there yet. We've still got a market that is not really pricing any cuts by the ECB. We've got earnings expectations that are pretty good. We've got bond yields that are still pretty high. We've still got a lot of concerns about inflation. I think all that's priced. The next thing we need to price is recession, and that will see much lower bond yields, much lower interest rates with ECB cuts, and much more weakness in the Eurozone bank stocks.
Any thoughts on why this is not priced in as of yet?
You listen to a number of strategists have become much more optimistic. Many of them calling for a soft landing. Some of them are our clients who we speak to. Others are, well-known independent strategists, Ned Davis, Ed Yardeni. There are lots of voices out there, which, respectable voices who are calling for a soft landing, and they're not looking for a recession scenario. So I would say it's a finely balanced debate. From our perspective, the evidence is growing almost by the week in favor of the recession scenario. So look, we've got a Fed. Recessions begin, cycles end when the Fed over-tightens, and there's a lot of evidence that they've done that, and if not, that they're about to do that over the course of the next 4, 5, 6 months.
If we get a softening in the economy, wouldn't central banks kind of pull the brakes and stop what they're doing?
Well, this is the really interesting thing, because central banks haven't really been tested yet. The easy, obvious policy choice has been raise interest rates because we have very high inflation and unemployment is very low. It's a simple decision. What happens when there's weakness, as you say, emerging in the economy? And that's when they get tested. That's when things get interesting. How will they respond to that? If inflation's high, how quick will they be to stimulate growth? And the reality is they'll be much slower, of course, to respond to weakness in the economy because inflation's high. And in fact, weakness in the economy is what they want. Reading between the lines, these Fed presidents have been saying essentially that they want to generate recession to control inflation. So it's part of their objective. I think that will increase the likelihood of recession, the fact that inflation is high.